Hi, it's Gregory Prado from Prado Capital in White Plains, New York, owner of the independent investment advisory firm Prado Capital. And we're here today to just talk about the markets. A discussion we have with our client, kind of a mantra, is history as a guide. We get more upset with the media and their supposed expertise at forward thinking when we are consistently combating that thought process and trying to educate and continue with the thought that history is a better guide than guesswork. So with that said, there's some pretty strong evidence, Apollo, that having your emotions affect your investment decisions can have a real negative impact. And again, what I like about some of this data is it's verifiable, right? It's historical. We're not saying so. Speak to that a minute. Like, what is the potential damage of having your emotions override the actual historical benchmarks of the market?
Right, and that's there's so many studies, and I think behavioral economics has for a long time looked at all these biases that people have, whether it's overconfidence, and I mean, you can have a whole seminar on that, and perhaps one day it would be fascinating to go on that. But when it comes to the data, there are studies that go back to the 90s and then 2000s, looking at the performance of investors who are letting emotions get in the way and some of these human biases. And what you find is that it's pretty consistent that you see the investors with underperforming the market when they're trying, particularly to time, and they say this is not a good time, I need to get out. And there's so much data when it comes to that particular aspect. One of the most powerful ones is what happens when you miss some of the best days in the market. And there are some certainly some good data when it comes to that particular aspect. So let me try to share with the audience some of the data when it comes to that. If you look at the performance of the S&P and then missing certain days in the market, if you're going to miss this is the long-term performance of the market, 1990 to 2018, based on the slides that Greg you just sent me, which are really insightful. This would have been a growth of $1,000 over this period in the market. If you just left it alone, don't touch it, just let it grow on its own. If you miss the one best day in the market, just one single day, instead of 13,137, you would have gone down to less than 12,000 bucks. By the time you go and you miss, 5 days or 10 days and 25 days, what you see is that it goes down from 13,000 to about 3,000. So you lost pretty much most of the market gains, and you're a little bit ahead of the 1 month Treasury bill. But here's what I think is so interesting is that I don't really have a good calculator in front of me, but if you take this, you're looking at 1990 to 2018. That is 28 years that you have in front of you. 29 years by then. So if you look at the 29 years and you multiply 29 years by, let's say, about 250 trading days in the market, well, it's a big number. I don't know exactly what it is. It's probably 7,000 days or something like that. It's close to 7,500 days, trading days in the market. And you're talking about 25 days out of 7,500 or so. It's a tiny fraction of the days, 25 days out of 7,500, and your returns can have a significant drop. So to me, you don't have to miss that many days, and you can have a disastrous investment experience. So that to me is so important.
Okay, folks, there it is. Another webinar, another story, another PradoCapital.com video. And we hope you really enjoyed it and got something out of it. And if you like what you saw, feel free to follow us, whatever we do on social media, subscribe to our services. And as a baseline, go to our website, PradoCapital.com, and we have a lot of content there and continued dialogue that we feel you might find useful. Until then, we'll be back online here shortly. Have a really nice day.